corporates, institutions, and down the road, even high net worth. So there's a lot of exciting things to happen with the creation of this new entity. I think we're almost 3 years this July already, and we have been slowly developing new solutions, new products, and soon, as early as next month, please watch out for our new UITFs. So Sun Life will also have our own unit investment trust funds. And with this, previously, I know I was in front of you as the CIO of Sun Life, but I think right now, with the growing business of Sun Life, I had to pass on that CIO role now to an even better investment manager who has been part of my team ever since we started back in 10 years ago in Sun Life Philippines. And I think now it's his debut to have his own media conference today. So I would like to welcome Richie Teo as the new Chief Investment Officer of Sun Life Investment Management. Thank you.
That we will be facing you face to face, holding this market briefing. No? Of course, hopefully you won't give me a hard time on the Q&A later. Hopefully when I give the market outlook, that will give more clarity on our market outlook from SLIMTC. So the next slide here, I titled the presentation from the Chinese idiom, paint the dragon that dies. So that's Hualong Tianqing. So that means, to give you an idea, this is a story based in China about a great painter named Chang. He painted 4 dragons in the temples of Nanxing. But he didn't draw the eyes of all of those 4 dragons. His reason was because if he drew them, the dragons will come alive and fly away. But there were detractors, of course, so he needed to prove them wrong. So he painted 2 of the dragon's eyes, and those 2 dragons flew away. No? So right now, in modern times, this idiom is used to describe something that is one step away from perfection. Okay, one step away from perfection, and this is how I probably like to describe our markets right now. It's one step away from flying away, from soaring, right, of the markets. But I'll keep this short since this is your expertise. You provide a good summary and story on what happened to the markets for our fellow readers, no? Which is very important. But in a nutshell, we saw last year markets battled high inflation, and that caused the central banks to hike rates by 100 basis points, both from the Fed and decelerating already. So they've paused during the last quarter of the last quarter of last year. So we saw also some turmoils, like the regional banking crisis in the US, the Credit Suisse event, but those didn't really matter much at the end goal on the bottom line of the markets, as we saw US really riding the Magnificent Seven and the AI sector, where they posted gains of 26 to 56% for the global equity, while for global fixed income, they gained by 5.4% on the back of rates were put on hold and inflation is on a downward trajectory. That will drive all of the other themes that we're looking at. With the rate cuts, that's driven because inflation has peaked. It will return to normal. And with lower rates, that will provide better corporate earnings. And with lower rate cuts, with low rates also, that will provide GDP to go back up to 6% from 5.6 last year, no? Driven by better consumption and private investments. And because of the high rate last year, we're also coming from attractive valuations currently, which will provide good incentive for the investors to come into the market. And lastly is the stable peso given that we're no longer seeing hikes of 100 basis points this year. It's stable already and even rate cuts. Okay? So again, then for peso, it's a big range, 53 to 55, given that it's really tricky to call this. But the main message there is we're seeing it stable. So right now we're at 56, so we don't see it going up way above 57, 58, or going down way below 53. That's why we're looking at 53 to 55 for this year. And for the rate cuts, here we're seeing 100 basis points for BSP. So bring it down to 5.5 from the current level of 6.5. Then for the Fed, bring it down to 4.5 to 4.75. So that's an equivalent of 75 to 100 basis points for the Fed. In 10-year, we're looking at 5.2. That's coming down from 6.2. Then for PSEI, we're looking at 7,200. MXWD, that's the MSCI All World, all of the countries, at 770. So in terms of return expectations, that will translate to 8 to 10%, both for global and local. Then for equity, we're looking at double digit as well, 9 to 11 for global equity, local equity 11 to 13%. So if you see, this is a good problem to have because we don't know where to allocate the most, given that all of them are very rosy, no? But as you can see, as later on, I'll also provide further details. We prefer more on the equity right now with this hike, but there's a lot of intricacies there in terms of timing as well. No? So strong numbers, it was pared down to 4 cuts. No? So they're seeing 5 quarter, it will go down to 4 quarter by the end of the year. But it won't stop there because if you go further down to next year, they're also seeing some more cuts. No? So that's about 5 cuts by January 2025. So this ever moving, but this also supports the idea of rate cuts. No? So the markets and the fundamentals are showing that it's really prime for rate cuts. No? And I think these cuts will remain there as long as we still see there's some probability of recession in the US. So right now, it's already lower, coming off from the 70s now back down to 45%. And as we see those rate cuts take into effect, it will fall lower back to the levels of 10 to 20%. Are looking at the market right now. So right now, based on surveys, they're looking at on this top left side, they're looking at small caps outperforming large caps. So this bodes well for equity if if small caps are ready to rally, no? So it's not just led by the big ones. Then here on the top right corner, this is similar to the recession probability that I showed, wherein there's really lower already, no? So the soft landing is at 80% already, meaning the hard landing, which we want to avoid, is only at 20% or 21% based on the latest survey by BOFA. And then on the bottom 2 charts, this shows to you how they are invested. So they're now overweight on the healthcare, tech, US equities. And if you compare US equities and fixed income allocation, right now, they're most overweight on fixed income currently. But why are they overweight on fixed income currently versus equity? This is because of the rate cuts. Once those rate cuts will come in, we will go back to the previous slide wherein equities will also follow, no? Because of the positive effect of lower rates. 7,200 is our base target. But we think that what's critical here is for the market to maintain its current price channel above 6.7. So right now it's trading at 6.9, and most likely this is something that we think can be sustained. Later on, I'll discuss what we think is different now for this year compared to the previous years. We've seen earnings actually increase already by 15% since the pandemic. Compared to the pandemic, it's 15% higher. But local equity markets, the index, hasn't really responded well yet, no? Because it's even 13% lower from where it was during pre-pandemic. So we can rule out that it's not really because of corporate earnings. It is probably underappreciated because of macro headwinds or low liquidity and lack of compelling catalysts. So these are the factors that we'd want to see change if we'd want to see our forecast of 7,200 base case fulfilled last year. And because of harvest, not yet harvest season, but with harvest season and El Nino going away, that will, hopefully inflation will be controlled. But that's the main risk here on the inflation front. Because with higher inflation, the rate cuts might not come as expected. Then the delayed infrastructure push may weigh on GDP growth. This one will dampen our GDP forecast. So this is also a risk that we're looking at. And the most interesting part, a wild card would be on the politics side, because this year we'll have a lot of major elections. We've already seen Indonesian elections concluded, wherein there's continuity, but still a lot more from other countries, most notably the US in November.